Welcome back to the Deep Dive. We're here to cut through the noise, get straight to the insights you need to be truly well-informed.
That's the goal.
Today, we're diving deep into Agilent Technologies, ticker symbol A. Now, this is a company that, often operates quietly behind the scenes.
Very much so.
So the big question is, can a company providing these fundamental tools for scientific breakthroughs really be the foundational giant powering the labs of the future?
And crucially, does its stock represent a durable long-term investment in, well, the relentless march of science itself?
Exactly. By the end of this deep dive, you should have a really clear understanding of why Agilent is such a critical player and, importantly, whether its current valuation offers a compelling opportunity.
It's a fascinating question because, we often celebrate the latest drug discovery or a new gene therapy, but we rarely talk about the crucial infrastructure that makes it all possible. Agilent lives in that indispensable space.
Perfectly put. So we're doing this deep dive into Agilent Technologies using data anchored to June 18, 2025. The stock closed at $115.52 per share then.
Got it.
Our mission, like always, is to extract the most important nuggets of knowledge and insights from the source material we've gathered. Really help you quickly become well-informed about this significant company.
Life sciences, diagnostics, applied chemical markets. It's a big player.
Definitely. And this deep dive, like all of our member-exclusive content, is brought to you by Stock Analytics AI.
That's right. Stock Analytics AI offers priority deep dives on tickers for their 4.999-month members.
And listen to this, over the next few months, they're covering all of the S&P 500 stocks exclusively for members. It's a fantastic resource if you're looking for in-depth analysis, so be sure to check them out.
Absolutely worth it.
Okay, let's jump right into part one, the core business management and financial health of Agilent.
All right. We'll kick off with Chapter 1, Business Understanding. So, Agilent Technologies, A on the stock market, it actually started as a strategic spinoff from Hewlett-Packard way back in 1999.
Wow, HP. That's quite a legacy. You can probably still see that engineering DNA, can't you?
Oh, definitely. You can really see that precision engineering mindset. But they've become a true global leader in their own right, focused now on life sciences, diagnostics, and applied chemistry.
Okay. And they made a pretty significant strategic shift, didn't they? Late 2024, moving from a product-based structure to a market-focused one. How does that actually, help them or their customers?
Yeah, that's a critical point. That reorganization, it's all about focusing on the customer's workflow, makes things much more integrated. They now have 3 distinct groups.
Okay.
First, the Life Sciences and Diagnostics Markets Group, LDG they call it. This is Agilent's biggest segment, about 38% of revenue.
38%, okay.
Yeah. It's their main growth engine, really targeting those high-value areas like pharma research, biopharma development, and clinical diagnostics. Think tools for drug discovery or critical cancer diagnostics.
Got it. Then there's the Agilent Cross-Lab Group, ACG. Now, this one sounds really interesting to me. It's the heart of their recurring revenue. Services, consumables, software.
That's exactly it. It's that classic razor and blades model we see sometimes.
Right. So how vital is that recurring revenue piece, especially, if capital equipment sales slow down a bit?
Oh, it's incredibly vital, hugely important. When a lab buys an Agilent instrument that's the razor, they then need Agilent's proprietary software, their branded consumables.
Like the columns and reagents.
Exactly. Chromatography columns, vials, reagents, you name it, and their ongoing services. Those are the blades. And this creates a really powerful, high-margin, sticky revenue stream. It provides that financial stability even when instrument sales might dip, and it's a massive driver of their overall profitability.
Makes sense. Okay, and the third group, the Applied Markets Group, AMG. Sounds like diversification.
Precisely. AMG serves these stable, highly regulated industries. Think food safety, environmental testing, which is huge now with forever chemicals like PFAS.
Right. PFAS is everywhere in the news.
It really is. And their PFAS solutions alone are already pulling in over $100 million a year in revenue. Plus forensics, advanced materials. It's about providing essential tools for compliance and safety. That creates really durable demand.
So it's a balanced mix then. You've got the big equipment sales, but also this growing, sticky, recurring revenue.
Yeah.
And it all added up to $6.51 billion in fiscal 2024.
Yep, that's the scale. And it's truly global, used in over 265,000 labs, 100-plus countries, 18,000 employees. It's a massive footprint.
It really is.
When we talk key products, Agilent focuses on application-focused solutions, basically covering the whole lab workflow. Their key instruments are these sophisticated workhorses, things like liquid chromatography or LC systems.
Like the Infinity Lab Pro IQ series.
That's one, yeah. And mass spectrometry or MS platforms.
Okay, so for those of us maybe not wearing a lab coat every day, what do these things actually do? Break it down for us.
Good question. Think of LC and MS systems as like the ultimate lab detectives.
Mm-hmm.
LC is like a super sophisticated filter. It separates incredibly tiny components in a sample. Could be a new drug compound, could be a contaminant in your water.
Okay.
Then MS acts like a high-powered fingerprint scanner. It identifies exactly what those separated components are down to the molecule.
Wow.
So they're indispensable for precision, finding new medicines, ensuring food safety, you name it. And the ACG engine, that cross-lab group, makes sure those instruments run perfectly, providing services, software for analysis, all the consumables, everything for reliable results.
Which leads right back to their main value proposition, doesn't it? Providing trusted answers to our customers' most challenging questions.
Exactly.
In fields like clinical diagnostics, where wrong answer could be, well, catastrophic.
Yeah.
They're not just selling a box. They're selling confidence, efficiency, trust.
That's a powerful position to be in. And if we look at the industry analysis, market trends and growth, the whole industry is pretty attractive. We're talking a projected CGR of maybe 10, 13% over the next decade.
10 to 13%. What's driving that kind of growth? Is it just general science moving forward or specific things?
It's a few major tailwinds, really. First, personalized medicine and genomics. Huge demand surge there, from tailored treatments, gene editing, cell therapies, all needing incredibly precise tools.
Makes sense.
Second, increasingly stringent regulations. Stricter rules on food safety, environmental pollution, pharma manufacturing. This creates durable, kind of non-discretionary demand for testing, like those PFAS chemicals again. If the law says you have to measure it accurately, you need the tools.
Right, it's mandated demand.
Exactly. And third, the big one, digitization and automation in the lab. Labs want integrated, automated workflows. This plays right into Agilent's strength in providing holistic workflow solutions.
And I guess that also locks customers in more, increases those switching costs.
It absolutely does. Once their systems are deeply embedded in a lab's automated workflow, it's a major pain to switch.
Okay, so what about the competitive landscape? Sounds like a tough market.
It is. It's basically an oligopoly, dominated by big players, Thermo Fisher Scientific, Danaher, Waters Corporation. These are the heavyweights, highly competitive among them, but incredibly hard for new players to break in.
And the regulatory environment itself is like a moat, isn't it? The FDA, European IVDR, high standards, making it tough for newcomers, especially for things like diagnostic assays.
A massive moat, absolutely. Yeah. The barriers to entry are exceptionally high. You need huge R&D investment. You have those high switching costs we talked about, customer lock-in, but plus the brand reputation that HP legacy helps.
Right.
And you need a global sales and service network. These are complex machines.
So given all that, what's Agilent's biggest, most powerful competitive advantage? What really sets them apart?
I'd say it's their ecosystem moat. That's the core of it. Once a lab buys an Agilent instrument, they get drawn into using Agilent's proprietary software, their branded consumables, the ACG services.
The whole package.
The whole package. And that creates incredibly high switching costs. It's just difficult and expensive to rip it all out and go with someone else. And look at ACG's operating margin, 32.4% in Q2 fiscal 25. That shows you how profitable that ecosystem is.
32%. Wow. No wonder they promoted the guy running it to CEO.
Exactly. It underscores how central that strategy is. Plus, they have over 2,300 active patents, strong IP protection, and economies of scale. Things like their Made in China for China strategy or the Ignite transformation for procurement efficiency. It's a very, very resilient business model.
That makes a ton of sense. Okay, let's shift gears slightly. Chapter 2, Management Evaluation. Padraig McDonald took over as CEO on May 1st, 2025. He's an insider, right? 26 years at Agilent and HP.
Yeah, a long timer. His appointment definitely signals strategic continuity, with a clear focus on strengthening that ecosystem model we just talked about.
Because he ran ACG before.
Exactly. His success as president of ACG driving, quote, outstanding growth, significant improvements in profitability and customer satisfaction that really highlights the board's focus. They want someone who deeply gets that customer-centric, recurring revenue engine. It feels like a very deliberate choice.
Makes sense. And what about crisis response? We saw some headwinds recently, cautious spending, tariffs. How's management handled that?
They seem proactive. They launched this Ignite Transformation initiative. It's essentially a big program for cost streamlining, making procurement more efficient, optimizing the supply chain, trying to make the company leaner to navigate those headwinds.
So protecting margins even if revenue growth slows a bit.
That's the idea. It shows discipline, which is good to see, especially after the softness in 23 and 24.
Okay. And how about communication, transparency, and, ethical stuff?
They seem to set high standards there. Their invested website is pretty comprehensive, clear standards of business conduct, code of ethics. And interestingly, the board seems responsive to shareholders. They actually eliminated supermajority voting requirements based on feedback.
Oh, that's a good sign of governance, aligning with shareholder interests.
Definitely. Now, thinking about capital allocation, Agilent's history shows some smart strategic moves. That Keysight Technologies spinoff in 2014 was huge. It let them focus entirely on life sciences.
Right, sharpening the focus. And their M&A strategy seems to have evolved, too. From big-scale building deals early on to more targeted acquisitions recently, like biotech for cell analysis or BioVectra getting them into the CDMO space.
Yeah, exactly. It shows they're willing to take calculated risks. They're not just buying revenue, they're strategically acquiring new capabilities. Things that enhance their current platforms or open up adjacent growth areas, like that contract development and manufacturing move with BioVectra.
Interesting. And management seems committed to returning capital to shareholders, too. Lots of share buybacks.
Oh, yeah. Active history there. They authorized new $2 billion programs in May 24 and Jan 23. And they plan to repurchase $750 million by the end of fiscal 24. That's about a 3% buyback yield right there.
Pretty significant. What about the dividend policy?
Also shareholder-friendly. They've increased the dividend for 10 consecutive years. The current quarterly dividend is 0.248 ounces per share. And importantly, the payout ratio is super conservative, only about 24%.
24% payout. That means it's very safe, and there's tons of room for future growth.
Right, absolutely. Plenty of cushion and potential for more increases down the line. Good for income investors.
Okay, one key metric often used to judge management efficiency is return on invested capital, ROIC. How does Agilent stack up there?
They do well. ROIC measures how effectively they use the capital invested in the business. Agilent's trailing 12-month ROIC is around 15.7%. Let's say 16% to be safe.
And how does that compare to their cost of capital?
That's the key comparison. Their weighted average cost of capital, or WACC, is estimated between 9.3% and 11.4%. So with ROIC comfortably above WACC, it proves the company is creating real economic value for its shareholders. They're generating returns higher than their cost of funding.
That ROIC number really does underscore their efficiency.
Yeah.
Okay, let's dig deeper into the numbers. Let's move into Chapter 3, Financial Health. First off, market cap.
As of June 18th, 2025, market cap was around $33 billion. So yeah, firmly large cap territory.
And revenue growth trends over the last 5 years.
The 5-year compound annual growth rate, or CAGR, is about 4.7%. Revenue went from $5.16 billion in 2019 up to $6.51 billion in 2024.
Okay, 4.7% CAGR. Steady but not explosive.
Right. And the path wasn't exactly smooth. They had strong growth in fiscal 21 and 22, over 18% and 8% respectively. But then things got soft in fiscal 23 and 24, basically flat, then down almost 5%. That was due to that cautious customer spending, especially in China and the pharma sector.
But things might be looking up now. Q2 fiscal 25 revenue was up 6% year over year. Beat expectations.
Exactly. That was a positive sign. And management guided for 2.5% to 3.5% core revenue growth for the full fiscal year 25. So maybe turning a corner.
Let's hope so. What about profit margins? Gross, operating, net. How resilient are they?
Pretty resilient, actually. Gross margin is consistently strong, 53-54% range. Shows good pricing power.
53% gross margin.
Yeah.
So for every dollar of sales, over 50 cents is profit before R&D, marketing, etc. That's pretty good, isn't it?
It's very good. It tells you they sell highly valued products and they do it efficiently. Operating margin on a trailing 12-month basis is around 23.5%, and that's improved over the decade. Net margin, also TTM, is robust at 17.6%.
And maintaining or even expanding those margins when revenue growth slowed. That really speaks to cost control and that high-margin ACG segment kicking in, right?
Absolutely. Testament to discipline management and the strength of that recurring revenue model.
Okay, and cash flow. Free cash flow generation. That's often a better measure than net income.
Definitely. And it's impressive here. FCF grew from $866 million in 2019 to $1.373 billion in 2024. That's a 5-year CAGR of about 9.7%.
Whoa, okay. FCF growing faster than revenue at 9.7% versus 4.7%. What does that signal?
It signals increasing operational efficiency. They're getting better at converting revenue into actual cash in the bank. Very positive sign.
So overall financial stability looks pretty solid then.
Very solid. They've got over a decade of positive and growing net income, reaching $1.289 billion in FY24. Debt-to-equity ratio is very conservative, around 0.57 to 0.60. S&P Global noted their leverage is consistently below 1.5x.
Strong balance sheet and short-term health.
Excellent. Current ratio is 2.09. Liquid assets are more than double current liabilities. Plus, like we said, 10 years of dividend growth, low payout ratio. It all points to stability.
Okay, let's talk valuation analysis. How does it look on a relative basis, say, using the PE ratio?
Right. Agilent's trailing 12-month PE ratio is around 28.5. Now, interestingly, that's actually below its own 5-year average, which was more like 35x to 37x.
So cheaper than it has been historically?
Relatively speaking, yes. Compared to its own past, it looks discounted. But how does it compare to peers?
Good question. How does 28.5 stack up against Thermo Fisher or Danaher?
It carries a premium to Thermo Fisher, which trades around 23-24x PE, but it's at a discount to Danaher, which is way up at 37-39x. It's pretty similar to Mettler-Toledo, another peer, around 28-29x.
So the market seems to be pricing it as a stable, quality growth company, maybe not a deep bargain, but not wildly expensive compared to some.
That seems about right. You're paying for that quality and the moat, not necessarily getting it on the cheap.
Okay, relative valuation is one thing. What about intrinsic valuation? Trying to figure out what the business itself is fundamentally worth using a discounted cash flow or DCF model.
Right, the DCF approach.
Yeah.
Forecasting future free cash flows and discounting them back to today's value. Sort of the Warren Buffett philosophy, right?
Well,
Buy below intrinsic value.
Exactly. So what do the DCF models suggest? I know these depend heavily on assumptions.
They do, and different analysts will have different numbers. Looking at some external DCF value ranges, you see figures from around $80 up to maybe $118.
Okay. And the key assumptions for our educational model, WACC growth rates.
We used a WACC weighted average cost of capital of 10.0%. Seems reasonable for a stable, large-cap, healthcare-related company. For growth, we penciled in 4.5% for the initial 5 years, kind of aligning with management's recent guidance and outlook.
Okay.
And then a more conservative perpetual growth rate of 3.0% after that, assuming it eventually grows roughly in line with the broader economy.
So plugging those assumptions into the model, what estimated intrinsic value range did we get?
Our model puts the estimated intrinsic value for Agilent in the range of $98.50 to $112 per share.
$98.50 to $112.
Oh,
Okay, keep that range in mind. Let's move into part 2, market dynamics, ownership, risks, and conclusion. Starting with chapter 4, market sentiment. What's Wall Street saying?
Generally positive. The consensus rating among analysts is a moderate buy. The average 12-month price target is floating around the $135 to $140 range.
Okay, 135, 140. Compared to the $115.52 price we anchored to, that implies what, 17-21% upside?
Roughly, yeah. Though individual analyst targets do vary quite a bit, from $115 on the low end up to $165 on the high end.
Got it. And what about the recent news and media tone? Has it shifted?
It has, somewhat. Late 2024, early 2025, the tone was pretty cautious. Lots of talk about softness in China, pharma spending pullback.
Right, reflecting that revenue dip.
Exactly. But after that strong Q2 2025 earnings report on May 28th, the one that beat expectations and caused a 6% stock jump, the tone shifted to more cautious optimism. Plus, they've had positive product announcements at industry events like HPLC 2025, keeping the innovation narrative going.
Okay. Any specific market indicators we should look at, like short interest?
Yeah, short interest is exceptionally low, only 1.46% of the float, and the days to cover is also very low at 1.8 days.
What does that tell us? Low short interest.
It indicates broad market confidence. Very few investors are betting heavily against the stock. Bearish sentiment seems pretty weak right now.
Okay. And technically speaking, moving averages. Where's the stock trading relative to those?
Interesting picture there. The price, $115.52, is currently trading above its 50-day moving average, which is around $110. That's generally seen as a bullish short-term signal. Momentum might be shifting upwards, but the price is still below its longer-term 200-day moving average, which sits up in the $125, $130 range.
So the long-term downtrend isn't broken yet.
Not technically confirmed as broken, no. It's kind of at a technical crossroads. Breaking decisively above that 200-day moving average would be a strong signal that a new bull market phase might be starting for the stock. Still needs to prove itself on that front.
Got it. Okay, let's look at Chapter 5, ownership structure. Who owns Agilent?
Well, institutional ownership is extremely high, about 91.8%. The top holders are the usual suspects, major asset managers like the Vanguard Group, holding nearly 12%, BlackRock with over 9%, State Street with over 4%.
So the big index funds and institutions have a lot of confidence.
It certainly signals that. Recent institutional trading activity has been a bit mixed, but generally stable, which isn't unusual for a widely held stock like this.
What about insider holdings? Management and directors?
Relatively low, actually, around 0.2% to maybe 1.1%, but that's pretty typical for a large, mature company where founders are long gone.
Okay. Any significant insider buying or selling recently?
There's been more selling than buying recently, looking at the transactions. However, a lot of that selling activity is flagged as disposition, non-open market,
Maybe.
meaning it's often related to things like exercising stock options and selling shares automatically to cover tax obligations, not necessarily insiders dumping shares because they think the stock is going down.
Ah, okay. Important context.
Yeah. And on the positive side, two new directors, Judy Brown and Pascal Soraya, made symbolic buys of 1,677 shares each back in May 2025. Always nice to see new board members putting some skin in the game.
Definitely a vote of confidence. And ownership concentration. Is it held by just a few big players?
The top 25 shareholders do control nearly 59% of the stock. But that concentration is spread among a diverse group of large institutions. It likely provides stability without any single entity having excessive influence.
Okay, makes sense. Now for the crucial part, Chapter 6, risk assessment. Let's use a SWOT analysis framework, starting with the strengths. A quick recap.
Sure. Core strengths. That technological leadership, 2,300 plus patents, the deep ecosystem moat with ACG and high switching costs, the powerful brand from the HP lineage, a diversified and resilient business across different end markets and geographies.
And that exceptional financial health we talked about, low debt, strong profitability, great free cash flow.
Exactly. Those are the big internal pluses.
All right. What about the weaknesses, internal limitations or challenges?
Well, as we saw, they are sensitive to cyclical capital spending by their customers. When budgets get tight, buying big new instruments might get deferred. That's a vulnerability.
Yeah, the 2023-24 dip showed that.
Right. Also, staying ahead technologically requires constant high R&D investment. That puts pressure on margins, even if it's necessary.
Is that R&D spend a major drag or manageable given their model?
It's significant, but likely manageable. That high-margin ACG segment really helps fund the necessary innovation without completely killing profitability. It's a balancing act, but one they seem equipped for. And finally, M&A integration risk is always there, especially with moves into adjacent areas like the BioVectra CDMO acquisition. Integrating different businesses can be tricky.
True. Okay. Balancing those weaknesses, what are the opportunities? Future growth potential.
Lots of potential. That secular growth in high-value markets, personalized medicine, cell and gene therapies, biopharma R&D, that's a massive tailwind.
Right.
Expansion in emerging markets like China and India still offers runway. New revenue from stricter regulations, especially around things like PFAS forever chemicals, seems almost guaranteed to grow.
Durable demand again.
Exactly. And their strong balance sheet gives them firepower for more strategic, bolt-on acquisitions to add capabilities or fill gaps.
Okay, now for the external challenges. Threats. What keeps management up at night?
Well, competition is intense. Rivals like Thermo Fisher and Danaher are huge, well-funded, and operate in the same spaces.
The oligopoly dynamic.
Yep. Global supply chain volatility is a constant threat, especially for crucial components like semiconductors or certain raw materials. Customer concentration risk is also a factor. Relying heavily on large pharma or biotech clients means a change in their spending can have a big impact.
And broader macroeconomic factors.
Absolutely. Inflation, rising interest rates. These can squeeze customer budgets, leading to those deferred capital expenditures we mentioned. General economic slowdowns are always a risk.
One specific threat we touched on, geopolitical factors, particularly U.S.-China tensions and tariffs, like the ones imposed in 2025. How big a deal is that?
It's significant. Tariffs directly increase their cost of goods sold, potentially hitting margins, and can disrupt complex supply chains. Management even acknowledged absorbing incremental tariff costs in Q2 25.
That it's a real cost, but they're mitigating it.
They are actively trying. That Ignite Transformation Initiative aims to centralize procurement and find efficiencies. And their Made in China for China strategy helps insulate some of their Chinese business from U.S.-China cross-border tariffs. So, yes, it's a threat, but they seem to be managing it proactively. Shows operational skill.
Okay, good to know. So let's bring it all home. Chapter
Yeah.
7, conclusion.
Yeah.
Synthesizing all this, what's the bull case for Agilent? Why invest?
The bull case rests on several strong pillars. First, that formidable razor and blades moat driven by the ACG segment and high switching costs. It's durable. Second, exceptional financial strength, fortress balance sheet, conservative debt, strong liquidity, consistent profitability. It's financially sound.
Rock solid.
Third, superior cash generation. Remember FCF growing faster than revenue. That signals increasing efficiency. Fourth, discipline and shareholder-friendly management, smart M&A, consistent dividends, big buybacks, and a new CEO focused on the core strategy.
Good alignment.
And finally, it's a pure play on powerful, long-term secular growth trends. Personalized medicine, biopharma R&D, food and environmental safety. These aren't going away.
That's a compelling bull case. Now, play devil's advocate. What's the bear case? What are the main risks or reasons for caution?
The bear case focuses on a few key things. First, that cyclicality of demand. It is sensitive to customer capital spending cycles, as the recent slowdown proved.
Right, it's not immune to macro trends.
Not completely. Second, intense competition. Operating in an oligopoly means constant pressure from very capable rivals. Third, geopolitical and China risk. Economic uncertainty there, plus the ongoing tariff situation, definitely impact margins and supply chains. It's a persistent headwind.
Okay.
And finally, valuation isn't exactly cheap. As we discussed, it trades at a premium multiple. It really requires sustained growth execution to justify the current stock price. It's not a deep value play.
So, recapping the valuation summary from our DCF model, the estimated intrinsic value range came out to $98.50 to $112 per share.
That's right.
Okay, so what's the concluding outlook? Putting it all together.
Look, Agilent is undoubtedly a high-quality, well-managed company. It has a durable competitive advantage, strong financials, and it plays a critical role enabling innovation in really essential and growing fields. The business has shown resilience, and maybe it's at an inflection point now with growth resuming.
But
At the current share price, around $115.52, it's trading slightly above our calculated intrinsic value range.
so maybe fully valued.
It suggests the market might already be pricing in a lot of the good news. While it's an excellent business, the stock might not offer much margin of safety for new investors right at this moment.
Even though Wall Street analysts see more upside, maybe to $135, $140.
Right, analysts are more bullish on the near-term price. But based purely on our fundamental valuation exercise, a potential investor might want to wait for a more attractive entry point, maybe something closer to or even below that $112 top end of our range. Patience might be warranted here.
Okay, a quality company, maybe just not at a bargain price right now.
That's a fair summary. Now, as we wrap up, here's a final provocative thought for you, our listener, to mull over.
All right, let's hear it.
How might the continued digitization and, crucially, AI integration within laboratories further solidify Agilent's already strong ecosystem moat? And looking forward, what new capabilities might they actually need to acquire to remain truly indispensable in what is a very rapidly evolving scientific landscape?
AI in the lab and Agilent's role. Definitely something to think about. Great stuff. And that concludes our deep dive into Agilent Technologies. We really hope you feel much more informed now about this critical, yet maybe underappreciated company.
Yeah, hopefully that was useful.
And hey, don't forget to like this video and subscribe to the Stock Analytics AI YouTube channel.
Remember, those 4.99-month members get priority deep dives on tickers. And over the next few months, we're covering all the S&P 500 stocks just for members.
Plus, if you are a member, you can add stock suggestions for future deep dives right there in the comments. Let us know what you want us to cover.
We're listening.
Okay, finally, the important bit. This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.
Always do your own homework.
Thanks for joining us on the deep dive. We'll see you next time.